Recording in progress.
Okay, cool. Alright, hello. Just opened up the chat. Yeah, so I'll keep an eye on the chat as well, as you guys have questions, but let's do a full analysis here. We had PPI data that came out today, so sitting at 0.7%, higher than the previous and the forecast, and we saw huge market reactions to that data point when we saw gold and even US30 reacting heavily to it with the push down. So basically what happened during London session across all pairs is that the market started pricing in the expectation that Powell was going to talk about how the war is impacting inflation, and now we have the expectation that we're supposed to get rate cuts in March, and then we pushed it back, into April, and now the expectation is that we're going to see rate cuts going into June. So that's why whatever he says important is going to be very important, because of basically seeing, how much do we need to wait for any potential rate cuts moving forward now? Are we on track for the June rate cuts, or are we going to see more rate cuts going into later into the year and potentially just holding going into June? So we know that they're going to hold interest rates. There's no doubt about that, but it's more about the forward guidance from this point on. Give me 1 second here. Okay. All right, let's do a full technical analysis first, and then we'll get onto the fundamental side, but we just went over the major one for today, which is PPI also confirming the fact that we are going to see interest rates being held. I do expect him to say that the economic outlook is still very uncertain, and then seeing potential volatility and liquidity sweeps, the typical moves that we usually see from a technical side, where you have massive wick rejections and then finally you get a move in one direction or another. Some of the key levels that we're looking at is, first of all, the 46,300. You have that massive bullish momentum to the upside already based off the weekly time frame, and then even off of the daily time frame as well. I'm actually going to bring that up a little bit higher into 46,500. What I'm looking to see is any levels where I see massive reactions. So I obviously see one here. Price try to break above, couldn't really do that, came right back down here, holding onto a support, push back up, got another retest. Another bounce here before creating a new higher high, came back below that level, ended up creating a new higher low formation, got a break and retest right at that level, push back up. So that tells me that there is liquidity that's sitting at this level. So I wouldn't really be surprised if price simply just made a bottom wick here and made some of these liquidity sweeps and then push right back up bullish. But that is dependent on what Powell says. If Powell is dovish, then I'm expecting that equities will push back up. But if he is hawkish, then I'm expecting that bearish trend to continue pushing down. So right now, this pair is still quite bullish. It's still in that bullish structure. Nothing has really changed here for the most part. It's just that it seems like we're testing structure at the moment. So if price breaks below that 46,500, then I'm expecting it to run all the way down into the 46,000 level flat, which is this previous support. And then that's going to be the major area where it would give me the confirmation of a new bear structure to the downside. Or price just again holds onto a support, and then we see that massive push back up. Another level that I'm going to mark off here is going to be this top wick rejection of the current daily candle, which is 47,300. If I look to the left, simply based off of the daily time frame, I see that price was trying to push back up bullish. We had a gap here, came back down, kind of tapped into this area here, and then continued pushing back up. We have held onto a support here, so it was like a break and retest formation before a continuation back up here once again. And that is where we're seeing these wick rejections for the past. This is the candle that really broke below that level. So 1, 2, 3, 4, and today's the 5th day. So this is a range that we're sitting in at the moment. Since 5 daily candles have been closing into this range and not really breaking below the 46,500, I do expect to see consolidation on some of the lower time frames. So when I come onto the 4-hour time frame, that consolidation pretty much has started. And then in London session, again, it was the expectation that Powell was going to, or the Fed was going to hold on to interest rates, and Powell was going to talk about the economic outlook being uncertain and potentially inflation expectations as well increasing. Now that we have PPI data that came out, that confirms the fact that inflation is increasing on the producer side. And of course, we know the cycle that if inflation is increasing on the producer side, then they're going to push those higher costs over to the retail side, and then the retail side is going to push it over to the consumer side. So ultimately, we will see that trickling cycle continue. But now that we're tapping into the 46,500, even based off the 4-hour time frame, the current 4-hour candle just started forming about 40 minutes ago. So we're kind of just tapping into this area, drop down to the 1-hour time frame, and we see, those wick rejections again happening around this area. What I'm going to do now is create a zone of where I expect price to give me some wick rejections, liquidity sweeps, and things like that. When I'm trying to figure out what are my liquidity areas, I'm trying to see where is the most reaction, and then where do I see the most volume as well. So when I map out this level, when I look to the left, I see a support and then a push back up. That was the higher low formation or lower high formation that we saw on the 1-hour time frame, daily time frame, and even the 4-hour time frame as we're pushing back down. Then we come back down into this level. We try to break below it, come back down or come back up, quick lower retracement, push back down here, and then we're kind of just hanging around this area here for the most part, right? Same thing here, held onto a support, and that is where we got that momentum to come back and tap into 47,300, pull back, another tap into 47,300, got a break and retest formation right here on the hourly time frame earlier today, and then as we're pushing below this, the last couple of hourly candles have been closing with weak body candle closures. So now we're sitting into an actual consolidation level, and when you drop down to the 30-minute, that becomes a little bit more clear. So what I'm expecting price to do here is that when interest rates come out, of course we know that they're going to hold on to the interest rates, so no surprise there. But whatever ends up being part of that monetary policy statement, I'm expecting price to give me some wick rejections, maybe tap into that, maybe just below it as well, and then give me a wick rejection to come right back up. Again, that is dependent on whether that monetary policy statement gives us some dovish hints. If it is more hawkish, if it says more of like we're just holding on to interest rates, we're going to watch what happens with the data points, and then anything about the war, then I'm expecting wick rejections into this area, potentially a little bit higher, and then come right back down into the zone and stay in this consolidation until the press conference. And then at the press conference, whatever the media ends up asking Powell, and however his answers are, again, dovish or hawkish, then we can see those potential moves. But this is kind of the area in general that I want to be careful of, between 46,750 and 46,800 level. Does that make sense? Any questions here?
No.
All right. So we're not going to create alerts here just yet. And then let's go over to gold, and then we'll go over to the currencies. Okay, cool. So now on gold, same thing, massive bullish run up, and then we had profit taking that was happening around the 5,600 level, push right back down here, right below that 4,400 mark, push back up again to more profit taking. So for the most part, we see a lot of candle closures right above this level. So even if we have these massive wick rejections, we're still maintaining that bullish volume above, let's just say 48.36 or 48.40. Any of that level is perfectly fine. And then what I'm going to do is mark off the current weekly candles body open right there, which is the previous resistance to the left. So 5,020.3. Drop down to the daily time frame. Again, just looking to see where I'm seeing most of the reactions here. What I'm going to do is bring this down a little bit more into this daily support and actually create a zone up top here instead. And the reason why I'm adjusting that is because I see that previous support where price did try to break below that area, but it couldn't maintain, pushing back down bearish. So it came back up, the next daily candle closed bullish, and then after that we just tapped into that 5,020.3 level, came back down, held onto a support here, and then maintained that bullish momentum to the upside, right? Which is where we came back and tapped into almost that 5,400 mark. What I'm going to do now is create a zone. So what I'm basically thinking about here is whenever interest rates come out, whenever the press conference happens and the monetary policy statements comes out and all that stuff, basically I'm expecting that price can give me some wick rejections right into that 47.76 area, or even around 4,800 flat, somewhere around here. And this is going to be the important part, because when I zoom out and I'm looking at the daily time frame, we are in that bullish structure, but this is the last major low or major support that I see based off the daily time frame, where I saw that volume to the upside. So if price can still hold on to this area of support, I'm expecting it to come back above that 5,000 mark and come closer to around that 5,200 area, potentially somewhere here. So anywhere basically back up top here where we see that consolidation on the daily time frame after a rejection here. If I don't get a rejection here and we see a push back up, then this is an area that I want to be careful of, where price can simply come back up, give me a top wick rejection here on the daily time frame or on the 4-hour time frame, and then push right back down, and potentially we just stay in this consolidation until we get more headline developments or we see more economic data points coming out, which basically supports, which way are we headed. Right now, a lot of the investors are using gold as a simple hedging tool. So it's not that investors are flocking over to gold just yet, but they're kind of on the sidelines. They're just watching what happens. There's some profit taking that's happening. And for the last couple of weeks and even the last couple of months, it's been more of buy the dip scenario for gold, right? So a lot of people that have been waiting for gold to dip back down, and then anytime there's a dip on these higher time frames, investors are just coming in and buying it. And then as soon as we tap in closer to that 5,400 or 5,600, some of these major levels, there's just a lot of profit taking that's happening. So this is not necessarily sellers that are dominating the market. It's more of that profit taking and the market just watching what's happening from the headline developments, from the economic data points, and watching, what does the economic outlook here looks like. If we are dovish here, then I am expecting that gold is going to be giving us some more volatile moves. So we just want to be a little bit more careful there. If we're hawkish, then same thing, we're going to expect more reactions off of these levels. And the most important thing in either of those scenarios is going to be just waiting for a break and retest formation and confirmations of candle closures prior to an entry. When I'm looking at the 4-hour time frame, massive sell opportunity, and then right at the New York Stock Exchange open, we saw a massive bottom wick rejection, came back up, closed bullish but kind of weak bullish. The current 4-hour candle again opened about 45 minutes ago, and we barely have a bottom wick, but we're not even pushing up with a ton of volume. So this is again just waiting for the interest rates that are about to come out in about 14 minutes and seeing which way we are headed. Now coming on to the 1-hour time frame, I want to look to the left of any major levels where I can expect more reactions, more wick rejections, any levels I need to be careful of, which is going to be right here, where you have that consolidation, previous resistance, support right here as well. So this area pretty much checks out as a major level that we need to be careful of. So looking at the current price action, I'm not looking for a buy here right now. I want price to give me a candle closure above this area on the 15-minute or the 30-minute time frame. So even on the 15-minute, we had that consolidation. We are starting to push back up bullish. Again, that is because of the expectation that Fed is holding on to the interest rates, of course, but also that we might get a push further when it comes to those interest rate cut expectations. So we could potentially see that we might not even get a rate cut in June. We're probably going to have to wait a little bit more. So these are just the market sentiment leading up to the actual release. So it's not any real concrete information that we have just yet of which way price is headed. So there's no clear direction here just yet. So let's wait for that volume. I want to wait for the first 15-minute candle closure after the interest rate news is released, after the monetary policy statement is released, and then figure out what the market is doing. If we're seeing massive wick rejections or if we see strong candle closures, then we have a confirmation of where the direction is headed. But if we just get a massive wick rejection, which is usually what we have gotten right when interest rates are released, then we don't have any clear direction on where price is going. Make sense? Cool. Now let's take a look at the currencies here too. Let's start off with GBPUSD. Alright, now that we're looking at the weekly time frame, structure here is still bullish from 2022, but the levels that we are starting to tap into are key levels based off of the weekly time frame here as well. If I just extend that over to the left, where we had that previous support back in 2016, and you can zoom out even further and you'll see how price keeps reacting at this level over and over again. So we had a major support here, price pushed back up, and then we finally saw that sell opportunity come back down here. We came back, revisited that area back in late 2017, early 2018, and then same thing, another nice sell-off. We came back to that level back in 2021 and even 2022, consolidated here before a retest and a pushback down, and then now we are revisiting that area here once again. Looking at the current support, same thing, just extend that over to the left, and we see consolidation here, consolidation here, consolidation here before a sell-off, and then another retest, and then another sell-off, another consolidation here. So this is a very important level because there's a lot of consolidation, which tells me another area of major liquidity. One other thing is, again, anytime you're looking at zones, if there's a lot of volume in either direction, you know that there's going to be a lot of liquidity and massive reactions to that level here. So same thing here, came back pretty close to that level, and that's where we're sitting at right now. So we don't have, again, confirmation of the direction here just yet, but this is more like, just a retest, potentially a new higher low formation if price continues pushing. This pair is very dependent on the US dollar strength at the moment. If the dollar continues to strengthen, then we will break below the support and continue pushing back down. But if we see a little bit of weakness or more relief from an investor perspective when it comes to the geopolitical tensions or the inflation expectations, then we can see GBPUSD push back up a bit more. What I'm going to do is mark off this previous support here as well off of the weekly time frame. Come on to the daily time frame. That is the current resistance that the current daily candles are holding on to. If I zoom out, previous support here as well. We did bounce off of this area with a nice little support, but we don't have any confirmation of this quick corrective move being over here just yet. If anything, we have created a new low compared to this intraday structure that we're going to see based off the 4-hour time frame and the 1-hour time frame. So overall, we still have this intraday bearish structure that we are still dealing with, which is not broken here. So that tells me that anything that I'm going to be looking for here is going to be quick scalps or even day trades, but I'm not looking for a swing trade opportunity unless price can clear above that 1.34 area. So completely break out of this short-term bearish structure, which is more of a corrective move based off of the daily time frame that we just saw. See some sort of a retest closer to that 1.34 area or a little bit lower, anywhere here, and then push back up. Those are going to be the swing trade buy opportunities. For sells, nothing just yet, because even based off of the 4-hour time frame, we're kind of just sitting in this consolidation here. So quick scalps or even day trades coming right back down into that 1.322 area. If price continues further down than that, then we just need retest and a continuation further. And if we look at the daily time frame, then that would break this bullish structure that we have to the upside. So even from here, it would break that bullish structure, so then we can at least come back down into this 1.3 area. So we have a couple of 100 pips that we can cash on GBPUSD, but with GBPUSD and EURUSD, those are major pairs, so I like to just swing trade those instead of scalp, because I can scalp US30, I can scalp gold, I can scalp GBPJPY, and those give me better returns rather than GBPUSD and EURUSD in terms of just, quick trades. This pair is quite similar to GU, but we'll still analyze that. Based off the weekly time frame, same exact thing. We are tapping into a key support level right here, which back in 2015 we tapped into it as resistance and then tapped into it again pretty much all of 2015. Came back, revisited that area back in 2016, finally broke above it in 2017, and then a push back up. Came back 2019, a ton of consolidation, another rejection in 2020, and then once again here in 2020, and then 2022. We came pretty close to it after that, but didn't really tap into it until early 2025, and now we are holding on to that area as support. So right above that, it seems like, a ton of consolidation, but we have pretty good swing trade opportunities, even if we were to just do like a zone-to-zone trade here, coming back closer to that 1.2 area. If I extend that out to the left, then we see how price has been reacting into that with all of this here, right? Resistance. So that is our zone-to-zone trade that we can look at for our potential swing trade opportunities. I'm still going to map out the current support. 1.142. Current level that price is tapping into, which is that core consolidation support. Drop down to the daily time frame. Price is trying to push back above that area. Last daily candle did close above that 1.52 area. The current daily candle is bearish with a bit of a top wick rejection. What I want to see is how price is going to be reacting closer to this area here. And that is because we have that support resistance on the daily time frame. So anything in between, I would just stay out of that. Instead, I would look for my swing trade opportunities when price breaks above this zone here, continue to the upside. We have a range of about 100 pips at the bare minimum to come back into the previous highs here, and then a continuation up. Let's say somewhere around here is where our weekly consolidation resistance is, so about a 300 pip range that we can target. Even if we're looking for sells based off of today's news, if price pushes back down, breaks its own low here on the daily time frame, we have about 80 pips to the downside that we can still target to come back into the support. Come on to the 4-hour time frame, quite similar to GBPUSD, where you have that corrective move that's happening, that intraday bearish structure. And so here we have ended up creating a lower high formation, a new resistance. Price is pushing back down, but we don't have enough bearish volume to keep pushing. So again, you don't have any confirmations of any sells or even buys here just yet. The 4-hour time frame did close bullish, kind of weak bullish with some top wick rejections. The current one is making a bottom wick, and it seems like it's flipping back up bullish. So if price breaks below that, then we can look for our quick scalp sells to come back down into this level. If not, I want, based off of the 1-hour time frame, 30-minute and the 15-minute, I want price to break above that 1.152 and then continue pushing for quick scalps for anyone who might be scalping major pairs. You have about 26 pips to come back into the previous resistance, and then about 47 or 50 pips depending on your entry to come back into that 1.157. Any questions on these? Okay, cool. Let's come over to GBPJPY. Weekly time frame, still quite bullish. And then we've had this nice bullish momentum to the upside here as well. I'm going to map out the current level. Let's just call it 213 actually, give it a little bit more room. But overall, this is the area that I'm watching out for. And then also the support, which is the current weekly candle's bottom wick rejection. We'll just call that 211. Come on to the daily time frame. I see consolidation here, push back up, comes back, retests into that area, holds on to a support, another retest. We're creating these equal highs right up top here. And then we try to break below that in early February, come back, consolidation, tap into that area once again, consolidation right below it. We come back and hold on to a support. The last couple of daily candles have been pushing back up bullish. So if price can break above this resistance, then we have that clean move to the upside for about 115 pips or so. The only reason why I'm being careful here is because price can just tap into that area like it did here and then come right back down. If it comes back down, then it's about a 200 pip range overall that we're looking at. If I come onto the 4-hour time frame and zoom out a bit more, then I do see rejections right into this area here once again. That bit of consolidation, and then you get that sell-off. Come back and reject into that area here once again, simply just to consolidate and give you a quick low retracement before push back up. Break and retest formation, and then you get that clean move to the upside. And then same thing here, and same thing here. So that's why I'm being a little bit more careful with the price approaching that 213 area. I want to see if it has enough bullish volume to continue pushing. If it does, then I want to catch a move like this to the upside. If it rejects it and then pushes right back down bearish, then I'm going to give it enough room to break below this area and then catch those sells to come back down. That way, we also break this little short-term bullish move that we see here, right? Even from all the way down here. Does that make sense? To the hourly, and then hourly you have that consolidation here. So in about a minute we're going to get that interest rates news that will come out, and we will also check out the monetary policy statement. Any other pairs that you guys want to go over? Oil, we're just watching. We're not going to be trading that. But we're sitting in that $94 to $100 range. So we still have that high inflation expectations here. USDJPY has not been a fun pair, so we have not been trading that either. But we have the levels mapped out, and we're using that to also understand the US dollar strength. Right, rates have been released, they have been maintained, and here is the statement. Available indicators suggest that economic activity has been expanding. Job gains have remained low, which is basically, again, unemployment. Unemployment rate has been little changed. Inflation remains somewhat elevated. That is what the investors are watching out for. Uncertainty about the economic outlook remains elevated. Again, just pushing that narrative of we might not see those rate cuts in June. And the implication of developments in the Middle East for the U.S. economy are uncertain. So now, just with this little section here, and this sentence here, that pushes the narrative that we might not see those rate cuts going into June. So we're going to watch what Powell says. But now we have that consolidation. What we're watching out for is any massive wick rejections in either direction. And same thing here for gold. And we have the press conference here in just a little bit as well.
Dropping to 4.3% next year. That's up from 4.2% in December. And the longer run estimate for Fed funds, seen as the proxy for the neutral rate, rises a tick to 3.1%. Guys?
Manaki, thank you, sir.
You guys can hear them, right?
A little bit later. Let's start with the price action. We've got equities, then bonds. We'll have a sneak peek of what's happening in the commodity market because we're tracking that throughout the day here at Bloomberg. Equity markets, looking at the S&P 500, off session lows, but still negative by 0.5%. In the bond market, yields slightly higher on a 2-year by 2 basis points, basically as you were at 370 on 2s, on 10s at about 421, which is basically where we were going into this decision. So this is what we're doing. You go into the projections. We'll ignore the statement just for a while. We'll go into the statement and we'll look at the projections and compare what they were projecting back in December and have a look at what they're projecting now. So let's just go through 2026 for GDP, revised slightly higher. That's some good news. 27 as well. Same thing, by the way. So they revised GDP higher, they revised inflation higher, and they've kept the projection, the implied projection for interest rates, exactly where it was for December. Those kind of moves should be music to the ears of bullish market participants.
This is an incredibly dovish hold, just by virtue of the fact that only one person dissented, and it was Governor Myron. That alone. But these projections highlighting a tolerance for higher inflation and still the belief that it will come down by 2027 to that 2% level without hiking rates and continuing with rate cuts gives you a sense of where this Fed's mind is at. This seems like more of a consensus than I expected, that a lot of people expected, and it is more to looking through any kind of oil price shock.
In honor of Alan Greenspan's 100th birthday, it was a Greenspan decision. Everybody got on board with the chairman. That's all there is to it.
And the out years, the good news on the inflation front, You decide whether this is good. The Fed is still basically forecasting the same inflation glide path as they were before, even with this lift to 2026.
How do you say transitory without saying transitory?
Right? It's in there in the forecast.
And that's the reason why you're seeing the yield curve steepen. And on the margins, you're seeing 10-year yields higher on this, because ultimately this is a Fed that is willing to stay on hold and look through an oil price shock, look through the fact that even core PCE has been higher than expected and is expected to stay that way. Because ultimately, they do think the labor market is showing signs of cracks, even though they don't necessarily see unemployment rate ticking up. And they do want to err on the side of being more accommodative.
One official I'd like to speak to, just briefly, get him on the phone. Governor Waller.
I was about to say, Chris.
Okay, no dissent. He said it was a coin flip. It would come down to the labour market report, and that labour market report was overwhelmingly soft. So what does he see in the outlook for inflation that's kept him on the sidelines?
Governor Waller, please join us. If you want to call in, we'll take you. I mean, ultimately, that is one of the key players, because he is a pillar of the swing vote, if you will. And a lot of people are looking to him for some sort of guidance about what exactly is driving his decision.
But at Washington State, he was expert on game theory. And when there's a war, there's a different game theory.
This is a major shock we're working through. Bob Michael at JP Morgan Asset Management still with us around the table. Bob, do you have any thoughts off the back of this one?
I do. They're telling us, don't worry about it. There's a little bit of a near-term inflation shock. They added a tenth more than we did, but it's fine. The economy is going to use that to accelerate. So they increased GDP. That I don't get. And they left unemployment where it is. And it also doesn't sync with the dots. I heard Mike McKee say that 3 members who previously voted for no cut changed their view, and went to a cut.
So I'm watching the 5-minute just to check the volume. The first 5-minute candle here, right when the interest rates were released. Usually we see a ton more volume, but that is an indication of the uncertainty that we have right now in the markets. So we don't have a clear direction on where we're headed. So that puts a little bit more pressure on that press conference that we're waiting for here in a little bit.
Temporary, not long-lived. You know, they could justify it perhaps by looking at the oil futures, which still show this as dissipating over time. But the short answer is nobody, including the Fed, knows. This is very elevated geopolitical risk, and there are risk on both sides. But
and then looking at gold's 5-minute candle, we have a lot bigger wick projections here, which adds to the part that, you know, there's a lot of uncertainty here.
How much this is just AI written all over it? How much this is a Fed that is basing their entire assumption on a productivity boom tied to artificial intelligence and the deployment of it through the economy, and frankly, disinflation on its heels?
I think there's an element of that, perhaps more so with the incoming chair than some other members. I think it's also a statement, however, that AI is a support to demand in the economy that to some extent, along with those big, beautiful bill tax cuts, is probably going to offset some of what the drag would be from the oil price increases. But again, this is a modal or a baseline, and I think certainly internally we'll hear that there was a discussion of the risk cases as well.
Professor Clare, when you were at Columbia herding cats, Xavier Sala Martin taught the acclaimed principles of economics. Talk to us about the risk of a demand destruction here. To me, it's extraordinary, whether it's war, short-term, or a more permanent demand destruction. Should that be a legitimate concern of the Fed?
Well, the demand destruction comes simply from the fact that not only oil prices, but energy prices and goods that are intensive in oil and energy will go up, and that will tend to reduce the real incomes for millions and tens of millions of households. Now, on the other side of that, you have the AI boom, but there is no doubt that this is going to squeeze real aggregate demand the longer the oil shock persists.
Check out the price action. Let's go to equities. We're still down by 0.6%, unmoved by what on the surface of things looks like a dovish decision from the central bank. Check out the bond market, similar story, no big moves off the back of this. The only takeaway, this can change, but the only takeaway for me is there is nothing this institution can do to drive this market in the face of the shock elsewhere. Jeff Curry of Carlisle said it really well earlier this morning on Bloomberg TV, when Jeff turned around and said there's nothing the central bank can do about this, you cannot print barrels. This market is still at the mercy of what happens in the commodity market, and the Fed is not the circuit breaker anymore, because this Fed decision, I would sit here and argue, is fairly dovish, with the exception of the absence of a dissent coming from Governor Waller. Is fairly dovish to come out and say the outlook for growth is better. We've revised higher the outlook for inflation, and the median dot is exactly the same. Screams dovish, and yet here we are. No big moves in financial markets. I think that's notable.
The Fed is playing dodgeball without the ball. They're not the pitcher in a game. And right now, what they're dealing with is shock after shock without necessarily historic precedent. Yes, there are historic precedents for oil shocks, but not for the AI shock and what that does to the overall economy. So they might remain on hold, and that might be bullish, but not in this moment, because right now, if another oil or natural gas plant gets bombed, people are going to be watching that much more than anything coming out of Jay Powell.
You know, Vice Chairman Clardo, the thing I would point out here, Damien Sassower at Bloomberg is very cautious on EM suddenly here. In this meeting and in this press conference, more than ever, is this the central banker to the world?
Well, sure it is, and I think that the Fed is aware of that. And I think one thing this episode is reminding folks, we've seen it in the dollar, obviously, is since the Iran hostilities commenced, the price of gold is down, the price of the dollar is up. So I think there is that element as well. But broadly, the Fed is reacting to events. I think Lisa said it well. First and foremost, this is a major geopolitical and economic shock. The dodgeball analogy, I think, is a good one. So I think, yes, the Fed is the central banker to the world, but it's not the main attraction right now.
Bob Michael with us with J.P. Morgan. So what is with the tentacles of J.P. Morgan around the world, how is EM doing? I see Philippine peso almost out to 60. You saw Australia raising rates in
Oh, whoa. We're calling Australia EM.
No, I'm not calling Australia EM.
Get you in trouble, TK.
No, I'm not calling. I'm watching Aussie yen though, which is a life of its own.
Sydney watching.
Was it Swissy?
They're early morning. Deeply unhappy with that.
But I read all the Neville Shute, including Tom Like Alice. I want to know, as a central banker of the world, the sensitivities he faces. What does J.P. Morgan see on the reaction in the currency markets, the reaction in fixed income of EM as the chairman speaks?
I think there are a couple things. One, we felt going through this that the dollar would be the safe haven bid. And we're seeing a lot of that. We also felt for those who wanted to diversify away from dollar, emerging market FX was the place to go. The central banks in those regions seem to be on top of things.
Yeah.
And you had a split between those who are energy importers and those are energy exporters, those that are sitting on rare earth minerals and other minerals, and those who aren't. And I think we're seeing all of that play out. But I will tell you, our client base still feels underallocated to emerging.
We have our
markets,
alert
both
set up here,
equity
but for the
and
most
fixed
part, it
income.
seems like a
We're
lot of
seeing
these
those allocations
pairs
continue to
have
come
now
in.
tapped into
I think
the
there's
key
some
levels that we
intent.
just analyzed or previous consolidation levels. So we're sitting at very important levels, but we don't have any clear direction just yet. And even with gold, we did try to push back up, and then we had this nice topward rejection on the current 15, which is going to close here in just a little bit. But here's the 5-minute candle, the first 5-minute candle after the interest rates were released, and then the next candle is pushing further down. And the current one, again, no clear direction. So we're back in this core consolidation here for gold as well.
He walks away and he does a $1 million speech in about 12 months' time and has a happy retirement. This feels so different, Rich. Kevin Walsh is ultimately being nominated. We have no idea when the confirmation hearing is going to be. Bob Michael sat here a little bit earlier and said he thinks the chairman, Jay Powell, is still going to be there by the time you get to the midterms. Rich, how do you think this process is going to play out in the next several months?
Well, you're absolutely correct. This is unprecedented, unusual. That the handoff is usually pretty smooth and very well telegraphed. And the difference, of course, now is several fold. One, of course, is the the DOJ investigation of Powell that the Fed is pushing back on. In addition, of course, even Walsh getting a hearing is now up in the air. I certainly do expect Jay Powell will stay on. And perhaps a meeting or two after Walsh finally arrives. Whether or not that's after the midterms, I'm not sure. I think Jay Powell will move on once Walsh is in place. to his future life. But his real focus is on maintaining the independence of the institution, and I think he will be in place until Warsh is confirmed, and perhaps a meeting or two thereafter.
Rich, appreciate your insight on the topic. Thank you, sir. Rich Clarida there,
Thank you.
the former Fed Vice Chair on this Fed decision and the Chairman's future. If you are just joining us on the programme, welcome to the show. So unchanged, the policy rate of the Federal Reserve about 15 minutes ago. Some dissent, the vote 11-1. That dissent came from an obvious place. Governor Myron voting for an interest rate reduction for the projections. Big focus on what was happening with inflation. They've lifted their outlook for inflation for this year at least, but left the median dot ultimately unchanged, implying one rate cut from this Federal Reserve for 2026.
To me, the most interesting takeaway is what you said, which is this market doesn't seem to care, even though this is very much a dovish hold. This actually is news in Fedland, and yet the market doesn't pay attention because there's another game in town, and it's everything else in the world. And some people might say, oh no, the adults can't control this. They can't step in and save us. And the other people will say, we haven't had a free market in a long time, and this is what it looks like. And guess what? It's a welcome exercise. And so those two sides of the debate are playing out in markets
We've
today.
got a free market.
Well, I mean, that's the whole thing.
All right, we have a 15-minute candle closure here. As you can see, quite weak, but it seems like we are maintaining that bullish volume to the upside. And, you know, as they are discussing it as well, and we saw it in the monetary policy statement, we are potentially seeing some sort of a dovish move where we might not see rate cuts until later this year. With gold also bearish here at the moment, but pretty close to the support area, so we don't have clear direction just yet. What I would like to see here in the next couple of candles is price holding onto a support. So come back down a little bit further, potentially hold on to a support here or into the zone and then push back up. For any buying opportunities, I think that would be perfectly fine. As long as we're closer to either of these zones, we can look for a trade here. But because we're sitting in the middle of the zone, that's why, you know, we're kind of just being a little bit more cautious of where we want to look for a trade. So don't look for a trade in the middle of the range. If you're closer to a support or a resistance, then absolutely you have better movements there. So now as we're getting closer to the press conference, and because of the uncertainty that we are seeing in the monetary policy statement, and even, you know, what they're discussing here, there is a higher emphasis on what Powell is going to say and any hints that he might drop. So this is when I would expect to see big wick rejections. I would expect to see more volatility. This is where your patience really is going to be tested a lot more. So it might seem like, you know, on lower time frames that you're getting a lot of volume, you're getting a good setup, but you don't want to end up becoming the liquidity for the market.
The idea that we're going to have a repeat of 2022 seems like a very low likelihood event, and therefore that's not something I would expect the Fed to react in that way, because the data probably won't support a reflationary type of environment.
Stephanie, given a war, given what oil's doing, John mentions it's 60 to basically 60 to 100 or even higher, we're still slaves to the job market. And the answer is the unemployment rate hasn't broken. With the war, with the distractions, how ex post is this Fed into the summer?
Yeah, I mean, I think they're going to be in an environment over the summer where base case the unemployment rate is probably steady, but they're going to be looking at this most closely. That's going to be the deciding factor between whether they're able to cut, probably not at Warsh's first meeting, maybe in September or December.
Right.
And it's going to all go down to the unemployment rate. Is it notably above 4.5, in which case they have a window to be able to ease? And if not, then it's going to be tough for Warsh to get the rest of the members on board.
Bob, synthesize Michael Feroli's work on this then. The fact is the labor market hasn't cracked yet. They have to wait, don't they?
I think that's part of it. I'm still gobsmacked by the Fed's decision. They're basically saying all of this going on in the Middle East is a speed bump. That, yeah, inflation will tick up, you know, 0.3 and 0.2 here and there, but the economy will accelerate, unemployment will stay stable, and it's off to the races. I just don't see that. I think there is a real impact to inflation and ultimately to the economy and the labor market.
This is the heart of the matter, John. This is the absolute heart of the matter, and everybody has to recalibrate their x-axis to how long is this going to go on, and then you get to demand destruction.
We mentioned this earlier, and I think it's important to keep going over it. We've repriced a lot in this market. We've repriced energy, had a big move from the 60s out to triple digits. We've repriced interest rates, we've taken out a lot of easing for the Federal Reserve, and we've priced in hikes in places like the ECB, 2 of them, I think, for this year now. Yet we haven't repriced growth, and the Fed hasn't either. And I'm not just talking about where spot is trading or the front month on the futures curve. If you go out to December and look at where December is trading right now, we're close to 80. So we've gone from the 60s to close to 80s on the December contract, and the Federal Reserve has lifted the outlook for growth. What's driving that?
I wonder how much momentum they think is in the economy, how much AI and data center spending is going on. Were they surprised by the Delta earnings and that, you know, sales are at a high despite higher energy prices? I think the reality is when you've had close to a 50%
I'll be right back.
hike in
Just gonna
energy
grab some water,
prices,
so I'll be back
it's
in
a
about
tax
2
on
minutes.
businesses and households, and they will respond by cutting back some of their consumption.
We have the smartest viewers, and I just want to point that out. One of the viewers wrote in, we do, and pointed out that among the members, the actual dots might say one thing, but the risk to GDP downside included 14 members versus 8 prior at the December meeting. The risk to the upside was 16 members for core PCE, as well as the unemployment rate. That was up from 12 and 13 members respectively. So that stagflationary outcome still in the back minds of so many of these Fed members. They just aren't making this their base case. So I don't understand, Bob, and I guess that this is my question. Is the reaction function essentially they will hold pat even in this scenario? Or do you have a sense of what the reaction function is to true stagflation?
Well, the bottom line is the market is just looking through the Fed right here and saying, doesn't make sense, don't get it, don't know what they were thinking, the projections don't make sense to me, but I know where we are. There's a lot of tension still in the Middle East. It's yet to completely play out. I think where we are now is about fair. It can go either way from here, so it's completely dismissive of the FOMC statement.
Hey, Stephanie, before you go, what's the #1 question for Chairman Powell into this news conference?
Yeah, I mean, the biggest question is going to be, provided energy prices are elevated through much of the summer, how are you going to think about the balance of risk? Is this going to be something that you're going to, you know, look through, and do you expect that growth is going to be lower as a result? Or is this something that you're worried about, more similar to 2022? And what are the balance of risks in your mind in terms of how this could play out?
Stephanie, good to see you. As always, thanks for jumping on. Stephanie Roth there of Wolf Research. To build on the conversation, Diane Swank of KPMG. Diane, I'm going to use a quote of yours to ask you the question. A dual mandate or a dueling mandate? What have we got?
A dueling mandate, and I think that's a real problem. I think the Fed is this dovish sort of numbers don't add up. I think I agree with that completely. A dovish pause is not what I would expect. I would have expected some people to actually put in rate hikes in this meeting, and they didn't. And I think there's a real issue about, we saw rate cuts in late 2024 to shore up the labor market. We didn't get any jobs. We saw rate cuts in late 2025 to shore up the labor market. I don't think we're going to get a lot of jobs from those. That brings up the issue is the problem in the labor market more structural and systemic, something that rate cuts alone cannot cure and spur the demand for workers on? If that's the case, if you cut rates further, you're risking a more persistent bout of inflation, or worse, a stagflationary scenario. And I think the devil in the detail is in that stagflation scenario. Also important is that they raise their non-inflationary rate. That is reflecting, yes, productivity growth and the idea that the economy can grow more robustly without having inflation, but that also means higher non-inflationary rate, which is an important marker to put down before Kevin Warsh takes on as Fed chair, since he has argued that productivity growth should lower that non-inflationary rate. That is not what the Fed is saying, and I think that's very important. But I'm very concerned about, we're 5 years in, we've got consumers expecting more inflation than they did in late 2024. And those expectations are going to rise, especially with salient prices like prices at the pump going up. And there's already a long tail due to the problems in the Middle East. Production idled is not easily brought back online. It's weeks to months, and we're rolling supply chains the world over. You create scarcities that go below the destruction in demand. That gives you stagflation.
Dan, is this the Fed meeting where forward guidance just died?
Absolutely. We didn't have a lot of forward guidance to begin with, but absolutely. And I think, what really will be interesting in the chairman's comments is what was the debate in terms of growth, what went into these numbers, how did the debate fall out. I think the devil in the details here is that there is a bit of a stagflationary concern out there, and there should be.
Diane, there's we suffer from 3 zip code scenario here in New York City. You've got a much greater national perspective. I take real issue with a narrow part of America being affected by $5 a gallon gas. How much of America is going to be flat on their back from some of these shocks?
Well, unfortunately or fortunately, we do have fiscal stimulus right now, and that fiscal stimulus will help absorb the shock instead of going into other kinds of spending, and that will help households. Tax refunds are showing up in consumer bank accounts right now, but the combination of fiscal stimulus with remember, inflation is accelerating right now. We saw PCE accelerate. We saw the PPI numbers today. The translation of the PPI and the CPI for PCE for the month of February hotter, especially on core services. That's aside from what's going on in terms of tariff-based inflation. That is important right now, and I think that's getting lost in translation, but it does show up in the depth and the details of those dots and how the forecasts show up. You could have had one very strong forecast push up the GDP number within the group.
All right, last 5 minutes before the 15 and 30 minute candle closure and the press conference. We'll watch the press conference together as well.
A number like that would have raised the overall growth figure when in fact the rest of the committee is seeing a more stagflationary scenario.
But tapping right into that consolidation support.
Pause. That is a bit disappointing right now, given where we're at, even though I'm very worried about the labor market. I just don't
So
think
same thing here, you
the
know,
Fed can
how for
cure
gold I was
what
talking
else?
about, if you're closer to the ranges, you can start looking for buys and sells, as long as there's confirmation, of course. So same thing here, we pushed down,
I think
and then
emphasis is
we've
gonna
come
be
right back
on
down into
uncertainty
support. So if
and
price
wait
starts
and
pushing
see,
back up bullish and I
and
start
that
seeing
will
some
just
more
sort of be
volume
where
here,
we are right now,
then I'm going to look
and
at the
that
15
we
minute and
don't
30
know
minute.
where the
If
next
those
rate
also start
move
flipping
is
back
actually
up
gonna
bullish,
be. And I think
then we
that's
can look
the
for
right way
those
to play it.
buys to come to the upside.
Ben, always good to catch up with you. Thanks for being
At the
with us.
bare
Thanks for
minimum, because
breaking
we are
down the
rejecting
Fed
into that
decision.
500
If you
area,
are just joining us,
even if you're
welcome to
doing
the
the zone to
program,
zone
the
trade,
conference about
which
four
if you're
months'
not
time
comfortable
with
with
the chairman of the
understanding
Fed
what is the
Reserve down in
limitation of your
Washington,
trade,
DC.
then don't do this.
In
Wait
any
for a
other
price
time,
break out of this
at any other
consolidation.
moment, we'd be talking
But
about the penultimate
you know, if you have been
meeting
trading
of
for
the
a
Federal
while, you
Reserve
understand the
Chair, but we have
limitation of
not
our
spoken
trade
to a
and you know all
single
that
person
stuff.
today
Then
who thinks
you can
this
look for
is
that
the
zone to zone
penultimate
trade.
meeting
You're looking
of
for
the
at least
Federal
100
Reserve
points to
Chair,
the upside.
and most
But
believe
we need that
Chairman Powell,
confirmation. What that
including
basically means
the former
is
Fed
that
Vice
this
Chair,
next 5 minute
is gonna be
candle
sticking around
has
for
to
at least a
close
few more
bullish here
Because
as
we
well.
don't know when the
And
confirmation
then
of the next
you would have the
Fed
new
chair is going
15
to
minute,
be,
30
and
minute
that
candle
ultimately lies
opening
with
up.
Fed
We want to
North
give that
Carolina
enough room to
Conference.
create any
Ultimately,
bottom
there's
projections,
question
and
about
then as that
credibility
pushes,
for the continuity.
you have a
I
quick
just
scalp
wonder
to the
if he
upside,
gets up there and he says,
but we
well,
want to
maybe it
catch the
doesn't matter
bigger
right now,
move.
as long
So
as
if
we
you're
don't
not
hike, as
comfortable
long as we don't cut that
with
much,
understanding what's the
we're not in the driver's
limitation of
seat.
your
And
trade,
also,
if you
this
have
is
a
their
problem
pass to say,
basically
this is an
with
economy that's moved
just
on to
increasing your
us. We are
TP,
not
being
in control.
optimistic with
We
your
are watching
trade,
it
not
just
really
like
understanding
everyone
like,
else.
okay, that is probably the highest that my trade is going to go, then don't look for that trade. But if you're okay with your limitations of your trade, you have really good risk management, really good trading psychology, really good discipline, then you know you're pretty much set to go. Just taking advantage
A
of the
big piece of
volume.
this bull case for this economy and for this market has been tax refunds. We hear that phrase get bandied around all the time on this program, tax refunds, tax refunds. How big are these tax refunds actually going to be? And how are
So
attitudes
as soon as this
towards the
5 minute
economy
closes,
changing
I'll
given the
open
shock
up
of the past few weeks? Where will that money
YouTube and we will
actually
watch
go?
the press conference together.
We're seeing it now when we look at Chase deposit accounts. We're seeing particularly the bottom couple quintiles of earners see their deposit balances start to go up a bit. But the uncomfortable truth is they're now paying because of tariffs on prices, and now energy prices are going to create yet another tax on their disposable income.
Grandma, the squeeze is real. The energy bills are severe, and they were high already, and now they're getting higher.
You know, Delta and American were perfect examples of how the economy is doing pretty well and people are still spending. The difference is that the costs are getting that much higher. And so the room that people have and that companies have to do okay is getting narrower and narrower, and the Fed's watching this, and they don't have the silver bullet to really make this a better situation.
I did scientific surveillance research today,
Here we go.
EWR to Charles de Gaulle. was popping the two of us. You could easily do it for $7,000, and you're enjoying it this morning just under $11,000.
We're starting to get
You're
a push
pretending
here.
you don't fly business class.
Over three. That's well, you know, that's.
Is that what you're doing?
No, it's not premier. We're not doing the first class thing, but
Okay.
business class, I'm going to suggest is up at least 20% instantly. Instantly.
Is that Polaris? Is that United Business Class? Is that the
Check
front of the
up
plane?
on
I
some of the
actually
other
don't
pairs
even know.
as
Yeah.
well. They're pretty much done here. Okay. With gold, we have come back. We had a key level, which is all of this here. Let's actually mark that off of the 15 so you can see that consolidation a little bit more clean. Okay. So based off the 15, we had this core consolidation. Right before rates were released, we've got a nice push up above that level, held onto a resistance. This top wick was from the rates release, came back down, tapped right into this level. Now, depending on whatever Powell ends up saying in the next couple of minutes, if we push back up bullish, then that is your break retest, where for the next candle to break the 15 high, and then you have your entry to the upside. For any sell opportunities, we are still waiting for price to break out of this consolidation, break below it, give us a top wick rejection, retest of some sort, basically kick the buyers out right below this level and then continue pushing down. As that happens, then you're going to zoom out, you're going to take a look at any of the levels to the left for potential partials. So here, you should have enough room for a break and retest formation here, top wick rejection, all that stuff to push down. Take your partials around 4,800, let everything else run down into 47.76, and then if you have runners, then coming down into the support here. Alright, so let's pull up the press conference. Here he is.
Economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East.
Okay, so everything that he is saying so far obviously is not looking very good for the economy. Also helps push the fact that we might see rate cuts later into the year, maybe not even June, it might be a little bit after that as well. So now what we're looking for here is, again, looking at the volume. We had a little bit of a push up, the current 5-minute made a bit of a top wick. We want to see candle closures here. So we want to wait for another 2 minutes or so, get that bearish volume candle closure down here, continue to push down, then hop back up to the 15-minute, 30-minute time frames. We're breaking out of this consolidation. You want to make sure you have volume on your side, and then look for your entry to the downside. When that happens, we are coming back down into 46,300 area here. So we still have, a couple of hundred pips that we can still target. Zoom out to the 1 hour, 4 hour time frames. I'll just map out. This is our first area of target. If price continues pushing down, then we know that this is the next area that price comes back down to grab volume to the upside. And that was the key level that we were watching out for on the daily time frame, right? Where if price pushes back down, then if price comes back and taps into this area, pushes back up, we're kind of testing structure here, the overall bullish structure. If price breaks below that, then you're into a bearish structure off of higher time frames. So now we're finally starting to get that bit of a volume here. So wait about 20 seconds, wait for a bearish candle closure, the next candle takes you down, you take that entry. Any questions?
The appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual
Nothing on
forecasts
gold
are
here
subject
just
to
yet.
uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs, so we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut, and each person has individual stories behind what they want to do, but essentially it is that, you know, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, you know, going through once and then tariff inflation coming down. We should be seeing that. And, you know, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you, Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it, but you know that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well, but yes. But no, there's also just the feeling that we haven't seen
real quick.
the progress that we had hoped for.
We just got a nice rejection here, so we had a first 5-minute candle closure. The next one started to kind of break the low, but we finally got that nice rejection. Here is the new 30-minute candle pushing down, the 15-minute as well. As this candle flips, we're looking for that continued bearish volume. We have about 10 seconds until this candle flips back down, but overall the sentiment looks quite bearish here for US30 to continue pushing. So these were the areas that we're kind of watching out for. That's exactly where we're seeing the reactions.
Again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, you know, diverting spending from other parts of the economy.
So I didn't get the second part of your
The consumer's going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That's
your
to
move.
your point. If we have high, if we have a long period of much higher gas prices, that's going to weigh on consumption. Now, it'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than.
Make sure you guys are following proper risk management, as we have talked about in
this is one of those SEPs where a number
the last
of people
live sessions that we did, and then also the weekly outlook and the market
This would be a
updates.
good one because we just don't know.
This is going to be a fast-moving market.
A conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and
I'm
this
just
is
waiting
something
for
that is
clear push below that
people
area.
wrote
Continue to
down.
push.
And
Check
so,
up on gold.
And, you know, we don't debate how long. How do you do
As
that?
well.
We wouldn't be able to debate what the length of or size of these effects would be. We
Gold
just have
has
to
a
kind
nice
of make an
reaction
individual
right here. So
statement.
still holding on to
also,
support.
you know,
No
what you've
entry
written
here
down
on gold
before
just
will
yet.
be, you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, you know, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing, you know, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, you know, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
what the staff is saying about, and has said in the past,
Yeah, so there'd be an offset.
Offsets, yeah.
So that's true. You know, we have we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about
Let's
doing more
also
drilling,
check
though,
out
they're
a
going to
couple
want to
other
see,
pairs
you know,
as we're coming close to the end of the
consistent
session. We got a
rise
perfect
in oil prices
reaction
from where
right
they
into
were
that
before the
1.335
buildup
for
the
GU.
war. And they're going to want to
Let's
believe
hop
that
up to
that's
some
going
of
to be
the
persistent
time
for a
frames.
fairly long
So
time.
based off the
they're
4-hour
not
time frame,
sitting
got a
there
nice
waiting for
rejection
oil to
right
go
there, but
over
we're still sitting into this bit
$70
of consolidation, so this is a
and then they
support.
start drilling
If we're looking for any
and then
continued
they
sells, we
make
want
this
price to break its own low and
careful
continue
judgment
pushing,
that
so
we're
those are
gonna
your
have
sells.
higher oil prices
If
for an
not, price
extended
just holds
period
onto a
of
support
meaningfully
here,
higher.
some wick
So
rejections,
I wouldn't say
not really
there's
pushing
much of
back
that
down, you don't have an
happening.
entry today,
Not
but we
much
do
of it
have better
happening
opportunities
now, but some
coming
of
up
that could happen over time
for the
if you
remainder
see
of the
that,
week.
but,
EURUSD,
you know, the
perfect
net of-
reaction,
the net of it
pushing
would-
back
the net
down,
of
same
the
thing,
oil shock
let
will
it
still
clear the
be
previous 4-hour
some
low,
downward
and you've
pressure
got
on
your sell
spending
opportunities to the
and
downside.
employment and upward pressure on
GBPJPY came up right into that 4-hour consolidation, holding onto a resistance. So no clear direction here just yet. And then based off the 30-minute time frame, also a massive top wick rejection, sitting right into that consolidation here. So overall, pairs are reacting off of the levels that we have analyzed at the moment. And USDJPY, we didn't really analyze that, but it is approaching that 159.8. I believe that should have been part of the weekly outlook for you guys. And then gold is still sitting into the support area. So this is going to be a very volatile environment at the moment. But from a technical perspective, we are starting to get some clean candle closures. So make sure that you are following proper risk management here. Now look to the left. US30 is the only clean move that we're seeing right now, but it's starting to push back down. First 5-minute bearish candle closure. Look to the left on the 15. We are starting to clear below this area. At the bare minimum, you have about a 100-point move coming down into 46,300. The current 15, no top wick whatsoever, so that's the only thing that you might have to worry about just a little bit in the sense of you're not moving to break even just yet or trailing your stop loss. But once you hit that 1-to-1, make sure you are taking partials. You want to use the 5-minute time frame right now just to check volume. This is not your confirmation for your entry. This is you just checking the volume. Can price continue to break its own low? Can it continue pushing down? And that's where you're executing off of. And then using your 15-minute, 30-minute, 1-hour, and 4-hour setups to confirm the direction. Any questions on that? Make sense?
Gives you confidence that inflation returns to target over the next couple of years.
Okay. So I would say that the rate is, you could characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices are the tariffs are paid by consumers on a one-time basis, and we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many years, it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to
EURUSD is clearing the previous low. So now what you're going to do is drop down 1 hour, clearing the low, 30 minute, 15 minute. So you had a massive candle here closing on the 15th. So this one, same thing. Let it push up a little bit more, or potentially at this point now you should wait for a break and retest formation if you're looking for swing trade opportunities. If your goal is simply scalping, then you can just take advantage of the volume. For that, still drop down to the 5-minute time frame. Look for it to continue to push its own low, but if you're looking for a swing trade opportunity or even a potential, for the most part swing trade, then just wait for a break and retest formation on the 15-minute time frame for your USD at the bare minimum, or at least a 30, and then you have that clean volume to the downside, a big enough range for you to continue pushing. Same thing with GBPUSD. We are back into that bearish volume here. So wait for your 15 or 30-minute break and retest formation for swing trade opportunities. For scalps, we are in high volume right now, so 5-minute time frame and 15-minute are in your favor.
You know, it's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you could point to the unemployment rate being stable, and, you know, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, you know, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September, so that tells you that. Inflation, you know, you can we're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8.
You should be hitting your 1-to-1 here soon on US30. So make sure that you are taking your partials.
Back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality, and I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth.
Alright, you're coming up close to the hourly candle closure here in a few minutes. So by this point, you should have secured your partials. If you have already taken entry on the last couple of candles that we were talking about. If you're entering just now, then again you have a very small range, but you can still catch about 100 points to the downside. But make sure that you're not getting too optimistic with the trade. This is the area that we're targeting. So catch about, you know, your 100 points at 1-to-1, get your partials, and then after that move to break even.
The effects we're seeing on prices, and it will depend
just
a lot
now,
on
then again,
what we can see in inflation expectations.
So this was a great opportunity. Make sure that you are still getting out of it as a winning trade and not a losing trade.
From the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market
Gold is sitting right into that perfect support zone. So nothing here on gold here just yet.
The quite negative number in February, would that be
GJ right into that consolidation and then pulling right back down. So just wait for it to continue making those higher highs and higher low formations. The break of that really is going to be at the alert that we have here at 212.1.
January report was a positive
And you've got
surprise,
your trades on
and the
GU
February
and
report
your
was a negative
EU.
surprise. If you put them together, you get something in the middle, and I think you have to realize, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job
20
creation
points
in the
away
private
from
sector.
TP being hit.
But
So again, if you
actually
have
that
not
looks
taken
like
partials,
that's
take your
about what the
partials. If
economy
you want to
needs
extend
in
out your
terms of
TP,
dealing
use
with
your
very,
higher
very
time
low,
frames.
non-existent
So on the
really
hourly
growth
time
in the
frame, we've
labor
already
force,
had a
which
ton of
which
bearish
we've never
volume.
had
The
in our-
hourly is
in our
going to form
history.
again in
So
about
you've
6
got
minutes.
a sort of
The next
zero
target after this
employment
zone is going to be down
equilibrium.
into the 46,000
That's
level,
balance,
and then
okay.
45,750.
But I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is
All right,
zero.
here's a new 5
But
minute.
nonetheless, it's something we're watching carefully, and so and are concerned
No
about.
top
But
wick at all, so we
ultimately,
have
though,
not kicked out the
you can argue that
buyers
it's
here just
a
yet.
consequence of deliberate
But at
policy,
this
which
point,
is really the changes
tapping
to
right into the
immigration.
zone, your
That's
TP
the biggest factor there.
has
And,
been hit. If not, increase your
nonetheless, something to watch
TP
carefully.
if that's what you want to do. But make sure you are taking partials. This should be your winning trade.
Thanks, Chair Powell.
That's pretty much it for
the
this
economy's
session.
experienced a series of supply shocks in the last few years. COVID, tariff.
Cool. Any questions? Did everything make sense? Anything else that you guys want to go over before we call it a session today? Perfect. Everyone's taken partials. Everyone's secured something at least off of the winning trade. Perfect. Beautiful. That's it. So that's the session, and then we'll continue to do some more live sessions on YouTube as well. But for us here with Zoom, we will have another live session tomorrow. That schedule should be already posted under events on Discord. If you guys have any questions, just message me there.